What's good, Kanekis? Welcome back to the channel. I hope you're all doing well. Before I get started, I'd like to say a big welcome to those of you who recently joined the channel after the interview with Rick Rule. Thank you very much for your support with that one. I really enjoyed sitting down with Rick. I hope you enjoyed the interview too. In this one, I will be talking about why Western governments can no longer afford a recession. I'm going to be talking about the UK and US governments, but really I'm talking about all Western governments. So France, Germany, Spain, Portugal, Japan. Japan is part of the West, let's be honest. Economically, they're part of the West. And I'll be giving you, I'll be going through the numbers as to why they cannot afford it. And it might be a bit depressing, but don't worry, there is always a solution, which I will talk about at the end. If you've seen my other videos, you can probably guess what it is. But before we get into this one, please be sure to hit the like button. It helps the video out a lot. It helps it to reach out to more people. Subscribe as well if you're new and you haven't already. And if you do end up enjoying it, please share the video because people need to know about this. Right, so let's get into it. Let's look at the numbers. We're going to start with the UK government. It says they raise about £1 trillion each year in revenue, mainly from taxes. So income tax, capital gains, national insurance, and VAT. Now, the thing about this is government can raise money in two ways, either by taxing or by borrowing. They don't really produce anything. So we're going to look at the percentages. 25% comes from income tax, 10% company taxes, and I'm going to focus on capital gains taxes. So what is it about capital gains taxes that helps to fund the government? So capital gains taxes will be things from, for example, selling your house for more than you bought it, selling stocks for more than you bought it. If the stock market goes up and you sell, you pay capital gains tax. Essentially, the reason they can't afford a recession is because in a recession, the stock market almost always tanks. So when the stock market tanks, it means that people are not paying capital gains tax on it. So government revenue goes down. In addition to this, company taxes will go down because people aren't buying as much. So they're getting less profits. Companies are getting less profits, so they pay less taxes. Income tax also goes down because people are being laid off. Companies can't afford to employ them, so they lay them off. So the government isn't getting that revenue from income tax, so that also goes down. So why is this an issue? Well, if if the government cannot raise the revenue it needs to run day-to-day funding, it has to borrow. So when government borrows, it forces all the taxpayers in that country further into debt. Because when the government borrows, they're spending our future income. And these numbers are similar for the US as well. So these numbers are, in terms of percentages, for the US, most of it comes from individual income taxes. Within this individual, they mix in capital gains taxes as well. I looked on Gemini actually about this, and yes, the numbers are similar. It said 48.7% in 2023, 51% so far in 2025. So we know the numbers here are legit. And they say about 9 to 14% comes from capital gains taxes. So if you do 14% or let's say 50%, so that's 7% capital gains tax that contributes to the total revenue. So it's about 4.5 to 7% due to capital gains taxes. So you can see the government has a vested interest in seeing that the markets keep rising, that housing prices keep going up. When they say, oh, housing is too expensive, the youth can't afford housing, they do kind of need the housing prices to keep going up, otherwise they don't get the capital gains from it. So why is this an issue? Well, if a recession happens, like I said, all these sources of revenues go down. The government is already in a deficit. So the US government is about $1.3 trillion in deficit, meaning they're spending $1.3 trillion more than they're bringing in. This is being covered by borrowing. Unfortunately, in a recession, government spending doesn't actually go down. They don't tighten the belts because they have all these social welfare programs such as Social Security in the US and the UK. That would be, I believe that's pensions. They have Medicare, Medicaid. They've got the defense spending. They've got the interest payments that they need to pay. One thing about the interest payments actually is that Unfortunately, the bond yields are going up. So that's the cost to borrow money. That's the cost for the government to borrow money. That the bond yields are going up, meaning without going up, interest payments are also going up for the government. And if the Fed cuts, we don't know for sure that the bond yield would actually go down. We saw in September when Jerome Powell cut, I believe it was the Fed funds rate. He cut the Fed funds rate and the 10-year went up. The 10-year interest rate went up. So, along with all these welfare programs that the government runs, they then decide to save the economy. When they see the recession happening, they're like, "Oh man, we can't let all these companies go bust. We've got to help the public. The public's suffering. We need to give them money." So this comes in the form of stimulus checks and quantitative easing that the banks do. Once again, they are borrowing to do this. They do not have the revenue to be spending like that. They don't have the revenue to save the economy. Save the economy. So right now they can't afford it. They can't afford it. The money just isn't there. I'm smiling, but I'm smiling to hide the pain because man, guys, look, listen. I have to speak honestly here. I do not see this ending very well. I have to be honest, I do not see this ending very well. The banks are gonna go bust because the banks are sitting on the bonds as well. Like I said, when Jerome Powell tried to cut rates, the bond yields went up, meaning the value of the bonds went down. All these banks are sitting on silly levels of bonds. The pensions are investing in bonds as well, and they're losing money. In a recession, the pension companies are likely going to go bust too. And all this is happening while the boomers, the largest generation, are about to enter retirement. I believe some have even started their retirement. So they're starting to pull money out of their pension funds. And the thing about these pension funds is they invest in the stock market and they invest in bonds as well. So as these boomers retire and they start net drawing fees out of these pension funds, that's funds that are leaving the market. I mean, the stock market is going to fall further reducing the likelihood that the government gets the capital gains taxes. So you can just see this downward spiral and yo, get out of Dodge. Get out of Dodge. Like this is the time to start saving, in my opinion. I think the time for investing in the stock market is largely gone right now at these levels, especially. It's all speculation. I don't think I can call it investing if you're buying into the stock market at these levels. It is speculation. Get out of Dodge, start saving. Personally, I prefer to save in gold. Like Rick said, you have to frame your mind around holding cash as well. Yes, it is very tempting to put everything into gold, but I suppose it is important to have cash on the sidelines as well. If you're putting it into cash, make sure you are sitting in a high yield savings account, something that's giving you about 3 to 4% on your deposit. Maybe some physical cash as well in the event that there's a bank run and your bank closes. You also want to have access to your cash. Remember, cash in the bank is not really yours. You've loaned the cash to the bank. And that is it. I suppose that's it for this one. Just to let you know that the government's out of money. They can't afford a recession. They can't afford a market crash. That's why they keep pumping the markets. Each time Trump goes on air and says, "Oh, Jerome Powell needs to cut," it's for this reason. It's for this reason. He's telling him to cut so that the markets can go higher. They are afraid of a recession. Rachel Reeves is also trying to cut the cash ISA. So currently the limit is 20,000 a year. She's trying to cut it to 4,000 a year so that people save less and they invest more. Once again, pouring more funds into the market so that they can end up getting the capital gains from it. The other thing about the capital gains that I like to mention is that the capital gains, when you adjust it for inflation, the markets have really gone nowhere. So I've done this before where I showed all the different stock indices, and in the dollar value and the currency value, it looks like it's reaching new all-time highs. So I'm gonna show you the S&P 500 real quick. So yeah, it looks like the S&P 500 it just keeps going higher and higher. But if you price it in gold, in actual money, you will see that it's actually much lower than it was in the year 2000. I'm going to show you the German stock index, the DAX. Looks like, yeah, it's reaching all-time highs. This is an asset class you want to be in, right? But price the DAX in gold, price in the euro, and you can see that it's not even close to the price it was in 2008. The FTSE, the UK stock index, supposedly it's just hit its all-time high, right? It looks like, okay, this is something I really want to be in. Not really. Not really. Look at that. It's practically at the all-time low, priced in gold. So the capital gains taxes you're paying on this, it's not really capital gains, it's actually eating up your principal. The only reason it's going up is because the currency is going down. It's not really the stocks that are worth more. It's not the stock market that's worth more. It's just that the currency is buying less. So you can actually call it inflation in the stock market. Yes, yes, the stock market is actually subject to inflation. So yo, listen, this is the best advice I can give. Obviously, it's not financial advice, but it's a recommendation. If I were you, as I am doing for myself, I would be buying some gold, I would be buying some silver, and I suppose put some cash away for emergencies. This is something I'm gonna start advocating for. I know I've been saying I'll get cash out of the banks, but I was recently bitten in the butt. I came up against an emergency where I needed some emergency cash, so I do recommend keeping some cash as well. But long-term savings, gold, silver, that's where you want to sit. The stock market overvalued. Once again, it is subject to just inflation. It's not really going up. It's ephemeral. It's not real. The capital gains you're seeing there are not real. They are not real. In real terms, adjusted for inflation, the stock market is not at an all-time high. Don't fall for the fiat illusion. Thank you very much for watching this one. I hope you enjoyed. I hope you got value out of it. Do be sure to protect yourself. Please hit the like button, share the video out with people who need to know this as well. To be honest, I think everyone needs to know. The government cannot save us this time. They never could. They can't save the economy. The next recession is going to be quite bad. It's going to be quite bad. If you want to see the stages of it, do check out this video I did on inflation, deflation, hyperinflation. So thank you guys very much for watching, and I'll see you in the next one. Peace.